everyone. Thank you very much for being here this morning. So excited to be back together and seeing each other's faces, I think. So I'm really glad that you're here. My name is Tom Bankston. I serve as the Managing Director of the Bank Holding Company Association. This session is called Insurance Considerations of Bank M&A. I know it's just a little bit past 11. We've still got people milling about in the hall, so I'm hopeful that maybe a few more people will find their way into this room. This session, of course, is also being repeated tomorrow when there are only 3 breakout sessions, so I suspect we'll have more people taking this in tomorrow. We have 2 presenters this morning, Craig Collins of Intact Insurance Financial Services and Deb Forsythe of Insurance Strategies. Craig is president of Intact Insurance Financial Services, a part of Intact Insurance. Financial Services offers property and casualty as well as specialty and excess coverages for commercial banks and others. Craig joined Intact, formerly One Beacon, in 2005. He has more than 30 years of experience in the banking and insurance industry and has worked with financial services risks across the United States. Craig also spent time with global financial risks at Lloyd's of London. Deb Forsythe is president of Insurance Strategies, Inc., an independent firm specializing in insuring community banks in the upper Midwest. She has worked with community banks for more than 30 years, and her areas of competency include risk assessment, policy analysis, coverage comparison, and program placement. Prior to founding Insurance Strategies in 2001, Deb worked at the former First Star Corporation. The session today goes about 45 minutes. Seminar attendees will have access to a recording of the entire seminar, including the breakout sessions, including this one, beginning next week. So you could watch that. You could share that with colleagues next week if you want. Watch for an email details about how to access that recording. So let's welcome Craig and Deb.
Thank you.
Well, thank you, Tom, and I appreciate everybody taking 45 minutes to talk about insurance. As you know, I always tell my children that whenever I say what I do, it doesn't necessarily draw a crowd in a party. But as we go through this discussion today, I think what you're going to find is, particularly in M&A, that the insurance provisions can be the fly in the ointment when it comes to getting everything done on a timely basis. And there's been many late nights where Dave or myself or Deb have been on the phone with somebody because that acquisition or that merger has been held up because something that's been found in terms of the insurance. So the hope today is that we're going to go through a couple of the key provisions on insurance as a whole. So we'll talk about the property and casualty, we'll talk about the bond, we'll talk about the Directors and Officers Liability, and just give you a general idea of some of the issues that occur and some of the things that have to be done before that acquisition or that merger can occur. So with that, the full legal disclosure, so the views are our own, not necessarily our corporations that we work for. And as I said, the general overview is we're going to talk about all the different lines of business. So even workers' compensation, cyber liability, all of these insurance coverages, and we want to talk about what is going to happen with the acquired bank and what's going to happen with the surviving bank. And so just a little ground rule, we struggled as we put this presentation together to make sure that it was easy to say the acquirer, the acquiree. The terms that we're going to use are the surviving bank and the acquired bank. So that's the best way that we can keep them from, because they're looking at things from a very different perspective. So that's the best way that we can use for terms to keep them separate. And so one of the first questions that we always get is, when does the acquisition occur? And for us, it's not the date that you announce it. It's not the date that you think it might happen, but it's actually the date that the merger is signed and the approved agreement is in place. In other words, the money has changed hands. From an insurance perspective and from a legal perspective and from a regulatory perspective, they're all the same. So many times we'll get a notification that, oh, it's going to happen on the 1st or it's going to happen on the 3rd. And what we find in a lot of the situations is it might not necessarily be then. It's got to be the effective date, and Deb is going to go into some great detail on the Directors and Officers Liability as to why that's very, very important. So we're going to start with the considerations of the acquired bank. This is the bank that's being purchased. So we want to talk about what happens to your policies when you have a change in ownership and what a change in ownership means. What do you need to have to protect your directors and officers and yourselves post-merger? And then also, generally, what you need to do if you have existing insurance claims. How do you handle those? What do you do? Who do you talk to? And so we want to make sure that you just get a general idea of that as you go through the process. So here I'm going to turn over to Deb. She's going to talk about Directors and Officers Liability, and then I'll talk about some other coverages in a second.
Go this way.
I'll go this way.
Trying to avoid accidents here.
There's a big, yeah, the insurance people, there's a big cord there.
It's the risk management in us. All right, Directors and Officers Liability. This is probably the biggest issue that you are concerned about if you are selling your bank. And so we're talking about discovery or tail coverage, and I'll add a third term, extended recovery or extended reporting period. So what this means, they're all the same thing. You'll hear it called discovery, you'll hear it called tail, and you'll hear it called extended reporting period. They are all the same thing. And it's typically purchased by the bank that's being acquired, and it funds the indemnification provisions that are contained in the merger agreement. And it may also apply to your cyber policy, which is also a liability policy. So a typical merger agreement, the language reads that the surviving bank shall indemnify, defend, hold harmless each present and former director or officer of the acquired bank for a period of X years following the effective date of the merger. And the indemnification period varies, and it can be 1 year, 3 years, 6 years, 85 years. It's what is negotiated between the parties. So why is discovery or tail coverage needed? So D&O insurance, Directors and Officers Management Professional Liability, is claims-made insurance. So what that means is it will cover a claim made during the policy period. And specifically, that's probably a lawsuit. Someone is saying, you owe me money, or you've harmed me. As opposed to an occurrence policy, which if Craig had tripped over that cord, the claim would have occurred when he tripped over the cord and hurt himself. So if there was a suit against the insurer, that could happen 30 years from now. And the insurance company in place today would have picked that up. Not the same with D&O insurance. It's claims made. Defined beginning, defined end of the policy. All right. So why is discovery or tail coverage needed? When there is a change in ownership, the policy, your policy stops at that change in ownership. And we're being very clear about the change in ownership, not if your charter still remains, you've still had a change in ownership. And this is one of the biggest misconceptions I think we run into. I'm selling my bank, but the charter's not going away until our IT conversion in 18 months. No, you have a change of ownership when your top owner is selling to another organization. So that means your D&O insurance stops, and it won't cover any claims after the stop date. Now, if a claim arises after that stop date, you need something in place to protect your board. If no tail coverage is purchased, then you're going based on capital. And so again, the tail coverage is your funding of that discovery period. Any questions on the need for discovery, what it is exactly? Why do you care about it? It's protection for you and your board, especially if they're not continuing. just to switch briefly, the bond also has a change of ownership provision, and the bond says it will immediately terminate in its entirety upon the taking over of the insured by another institution. So again, even though your charter may continue, you have a new owner and your bond is terminating and won't cover any claims.
I think we trade.
Ready to go again?
Just to talk a little bit about the tail and why this is such an important issue and why this really becomes the problem in a merger, is that the whole purpose of it, and as an insurer, my perspective is, let's say I've got the acquired bank. My perspective is I want to protect the directors and the officers of that bank. And so it's just key for me to make sure that any kind of action that you take from a tail perspective, you do it before the date of acquisition, because if it's after the date of acquisition, even if the existing directors come back and say they want something, it's basically too late. And we'll give some examples of this, because the whole point of it is to protect the directors and the officers of the acquired bank on the tail. So a couple of actions that if you're acquired, the things that you want to get done. And the first thing is, when possible, and we realize that there's confidentiality, however, as an insurer or as an agent, we fall within the need to know in terms of who can know about a merger or an acquisition. So we know an awful lot of the ones that happen months and sometimes 6 months before they do happen, particularly during the financial crisis. We had an awful lot of what we were calling Thursday night specials, where we would need to know which bank was being acquired, and we'd have to get the insurance taken care of on Thursday night before Friday. So the first thing, and I'm just going to kind of talk about some of the issues that have come up in the past, is if you're the acquired bank, you do need to talk to your insurance agent about how much is the tail going to cost, how long do I want to have it, and Deb used 85 years, and I winced because 6 is about as long as the insurance companies are going to do. And that premium is calculated based upon the annual premium times a certain factor. And so the key here is to talk to your producer in advance, and they can tell you generally how much it's going to cost, because as part of the acquisition agreement, you need to make sure you factor in the costs of the tail coverage for the directors and officers. So if you're going to leave with one thing after 45 minutes of talking about insurance, I would say that's the one, is to talk to your producers in advance about what the cost is going to be, so that you can factor it into the acquisition agreement. Because we've had several situations where it comes in and they want a 6-year tail, and they say, or even more, let me give a better example. We want a 10-year tail. And we say, well, we do 6. And they say, but this is in the acquisition agreement. Well, that's great, but the insurance industry is going to do 6. And so all of a sudden, everything stops. Everything stops. Everybody goes back. There's renegotiation. And a lot of those could be taken care of in advance if you talk to your producers early, or your insurance agents early, to get that taken care of. The next thing to do is, if you're in the process of being acquired, is to make sure that you have copies of all of your insurance contracts to give to the acquiring bank. You've signed your NDA. It's really important for them, because I promise you, if you have that information in place, and we're going to talk about some other coverages here in a second, if you have that to the acquiring bank, the transition is going to be a lot smoother, because they're going to know about your prior claims history. They're going to know if you have any outstanding claims, because that's what the acquiring insurance company is going to want to know. And then this is the next item, is the payment for the tail coverage. And I don't get a lot of mail, but I promise you that the most frequent mail that I personally get, because for some reason in the policy my name is on it, I get checks in the mail. And you're like, what? And what it is to make sure that it's postmarked appropriately, or sometimes it's certified, I will actually get the check in the mail from the acquired financial institution for their tail policy. Well, it'll come directly to me. And the whole point of that is to make sure that the check has been written, has been sent before the date of acquisition. Because the minute that the bank is acquired and that hasn't been done, then we lose all kinds of flexibility about what we can do for our directors and officers that are being, quote, acquired. So that is probably the second important point that I would make, is that if you're being acquired, number one, you negotiate what your tail coverage is going to be, and number two, you make double dog sure that that check or that payment is made to the insurance company before the date of acquisition. On the cyber policy, it continues in full force until termination. But here again, just like the D&O, it only covers claims for wrongful acts. It's also claims made. And so you need to make sure that your cyber policy, that you have a copy of it, that you've given it to the acquiring bank or the surviving bank. I get my terms right. The surviving bank, so they can get you added onto their policy on the effective date of the acquisition, so that there's not any gaps in coverages on the cyber. On the property, the auto, the umbrella, the comp, there again, what will happen on those dates, the date of acquisition, that property policy of the surviving bank is typically canceled, and the new bank, the acquired bank is canceled. The surviving bank will then add the autos that will add the package policy and put that on the date of acquisition. And you heard me talk a little bit earlier about how when you do that, you want to make sure that you've got copies of the policies to give to the surviving bank to make sure that they get everything right. So the square footage of your building, the values of your building, all of those types of things that the new insurance carrier will get. On comp, change in ownership within 90 days of the date of change, that typically will then be cancel, re-rate, and move to the new company. If I'm not mistaken, the mods for the workers' compensation mods, which is basically your score from the state, I believe that the surviving bank's mod is the one that's calculated. Am I right on that, Dave? Yeah. So you run the chance there from a comp perspective that if you as the acquired bank have a better mod, and in other words, better loss experience, but the surviving bank has a more difficult loss experience, that you probably will be charged a little bit higher, at least for about 2 years, until the averages of the losses of the combined organizations come together. If you're the surviving bank, now here's where, again, knowing in advance, talking to your producers, the first thing that you'll want to do is to look at the combined consolidated assets of the banks, and you want to see if you've got the right limits. So if it's a merger of equals, you don't necessarily need to double your limits, but what you really need to do then is you need to go and get a peer analysis of what, let's say you're a $2 billion bank and now you're a $4 billion bank, or a half a billion and now you're $1 billion. There's data available that will say all of the insureds or all of the banks in the United States, based on asset size, these are the typical limits that you have. So it's really important to know that just because you've doubled in size does not mean that you need to necessarily double your limits. And that data is available through your producers or through your insurance companies as well. The next thing is make sure that you do get the loss histories of the acquired bank, because the new insurer will look at that and see, okay, do we have issues of frequency in losses? Do we have a lot of wire fraud losses with this new bank? Are there policies and procedures that we might see as an insurer that we might need to make sure are incorporated into the new bank? And those are types of questions that can slow up the process, because when you're in this process right now, you want to get it done as quickly and efficiently and as accurately as possible. and the loss history information is very helpful for that. The next is, how does an acquired bank's insurance policies address a change in ownership? And a change in ownership doesn't necessarily mean, you could literally have a scenario where the acquiring bank is buying 50% and 50% is still with the existing shareholders. Every policy is different, and there's some mathematical calculations that you have to look at every insurance carrier and every policy to confirm that that change in ownership actually exists. So it's a nuance, but I have seen a couple of accounts. For example, I have an account that I've just looked at in a southern state that got new owners, changed their name, and did not do anything on their insurance policies. And unbeknownst to them, because nobody looked at it, and this is not my insured, but this is one that we're looking at, that from the moment that they changed ownership and changed their name, they did not have a go-forward D&O policy, because the D&O policy converted to the what we call the runoff provision, because nobody did anything before the date of the change of ownership, which it was acquired, and it wasn't necessarily merged into another bank, it was just a change in ownership. So if you have that majority change in ownership, you really need to look at your policies. And so this bank is literally going to go for 6 months before it was discovered that that their policies had turned into runoff, where they do not have coverage for their directors and officers because of that. So
They probably didn't have a bank bond either.
Yes, that's correct. That's correct. So that's another even, you have to have a bond to really operate as a bank, and so their bond did the same thing. We'll talk a little bit more about what's covered and what's not covered from the acquired bank. And then, like we said, the limits, the deductibles, everything like that. Once you make an acquisition, you need to step back on your existing policies and make sure that what you've got is correct for your size. And also, we also find a lot, when I'm dealing with banks that have a lot of acquisition activity, they may buy a bank that does something different than what they do. So for example, they may have a trust operation, and the surviving bank doesn't. In that case, it's really important to sit down and say, okay, well, now we need to have trust errors and omission coverage on our new policy, or our policy going forward, that we didn't necessarily have before. And that's where you sit down and you talk with your producers and with your insurance company, who do this all the time. And usually when I sit down with a banker, and we know an acquisition's coming, that's another one of the areas that we have a long discussion about, is if there's any types of services that the new bank is offering that the surviving bank does not. On the bond, and again on the D&O, now we're going to get really wonky here, so please buckle up. There are provisions in the bond and in the Directors and Officers Liability where there is automatic coverage for an acquisition. And I'll just give you ours, and I know every carrier is pretty similar. But our provision says that if the acquisition is less than 25% of the combined assets of the bank post-acquisition, that there's not an additional premium charge to add the bank. In other words, for that short period of time, and this is really there to pick up the small acquisitions, and you'll end up paying your premium, but it won't happen until your next renewal. And so there's a little bit of algebra that you have to do when you find an acquisition to see if it falls under the automatic acquisition threshold. And then if it does, then the insurance company will probably ask a couple of questions about claims, maybe get an application on them, and then once that's done, then they're added on to the D&O policy, or added onto the bond, or added onto the cyber automatically until you as a surviving bank's policy renew. But the key is that 25% of assets. So if it's a small, and we see this quite a bit, and then if we have a highly acquisitive bank, which we have many of those, that may have 3 or 4 over a three-year period, all of a sudden their insurance premium renews and it's a lot more than what they had before. We have to gently remind them that the reason that it's that way is because you had automatic coverage until the end of the policy period. So that's where we have to have Deb use her negotiating shoes to explain to our banks that you really got a good deal for 2.5 years or 2 years until it was re-rated. There are some caveats to that, though. If the bank, the acquired bank, is under a regulatory agreement, then there's some breaks and some provisions that slow it down and say, okay, we need, as an insurance company, we need to understand what's going on to make sure that we're not picking up a lot more problems than what we're charging for. On the cyber, as a surviving bank, there again, you can pick it up on the automatic provisions on some, but the insurance company will typically ask for a general just application to see what kind of services, what kind of activities are going on in the acquired bank, just to make sure that there's not additional services that maybe are not contemplated on the surviving bank's cyber. On the property, the auto, the umbrella, you pick up losses, of course, and realize too that you're picking up losses that occur after the merger. If there's a loss that occurred before the merger, so if the building burnt down 3 days before the merger, that's going to be on the prior insurer's property and casualty policy. It doesn't convert over, and we do get some of those on, let's say, liability issues where there might be a liability loss that's going on for a couple of years, and they'll say, well, but it's now on this policy, and the answer is no. It's based on when it was discovered. And then on the comp, there's a few reporting issues that you need to do. And again, your producer, your insurance agent, your insurance broker will know how to walk you through that to make sure that you've got the comp kind of restated with the new employees. Now here's a few steps again to talk about on the surviving bank. Even though you as a surviving bank are not paying for the tail coverage, I promise you that if you don't have this discussion early in the acquisition period, there's going to be discussion saying, well, you should pay for it. No, you should pay for it. And even though the check has to come from the acquired bank, it's very, very important to contemplate that, okay, well, my acquiring bank is going to have to pay for this tail coverage, so that should be incorporated into the cost of or into what the purchase price is. And we've talked about how having a 3-year loss history is important to make sure that there's not something brewing that's going on that you might not have known about during the acquisition process. As a surviving bank, again, you want to let your producer know that you're going to have that acquisition as soon as possible. Their perspective will be very different than the acquiring bank. The acquiring bank's producer will be worried mainly about the tail. The surviving bank will be worried about making sure that the existing policies have and cover and contemplate all of the new activities and the building values of the bank that's going to be part of the acquisition. And then also have that discussion with your producer, with your agent as to when you need this done by. Is it 30 days? Is it 60 days? Is it before the acquisition? Have your expectations set, because it will go a lot smoother if you're meeting the goals and they're meeting the goals, to make sure that the insurance isn't that surprise that comes out at the last second, and it happens. So,
one moment here.
yes, ma'am.
Craig. And we mentioned earlier that we would talk about what if there's claims occurring or in process before the acquisition date. Those all go back to the acquired bank's insurance company. So there's a definite cutoff of the acquisition date, but if there's anything in process, that needs to go to the acquired bank's insurance company. And the surviving bank is interested in knowing that.
Yes. So what Deb's also referring to is that's right before acquisition is a really good time as the acquired bank to have a good look in your heart and see, is there something that's going on right now that I need to report to my existing insurer? So is there maybe some litigation, and we see scenarios where there's some litigation that the time that it comes out seems pretty minor, but and they haven't reported it to the insurer, but lo and behold, it just keeps building and building and building, and at some point in time, it might become significant. Do they need to make sure that they report that before the date of acquisition? So it's a good little cross-check to make sure before the acquisition is actually signed. Okay, now this is what everybody always likes to talk about, claims. And I'm just going to give you some examples of some of the claims that I've had over the years. Right now, I insure about 20% of the banks in the United States, so mainly in the upper Midwest, and but an awful lot in Texas and in the South and in the Pacific Northwest, but mainly in the Midwest. And here are the trends of the losses that we as insurers pay. And my perspective is going to be on privately held. Publicly traded is a completely different discussion. So I'm going to focus mainly on the exposures of privately held. And of course, the big one for us is it seems to be always in employment practices. It's always the scenario where you've got two of everything. And particularly if you're in in close proximity, and you've got to make decisions as to who's going to be the CFO, who is going to be the chief operating officer. And we get an awful lot of litigation that alleges, well, you didn't select me because I'm over a certain age, or you didn't select me because of this or because of that. And so we get individual wrongful termination scenarios. Unfortunately, they tend to be very expensive for us because at this point in time, those people that you have two of tend to be the highest compensated people in the bank. And so the higher you're compensated, the more expensive a wrongful termination suit is to either pay for or to defend. The next one is a little bit more sinister. This is even after you have major selection as to who's going to go forward. You can still be found kind of in violation of employment law for disparate impact. So I'll just give you a good base example here. A good base of disparate impact is, so you have two CFOs, you have two of everything, and it turns out that in your selection process, which you did based upon qualification, every single person that moved forward in the organization is male, and every person that was outplaced is female. Now, I understand from a qualification perspective that might be on its face what was the sterile thing to do, but then you can find yourself being guilty of disparate impact. That means that you've impacted a protected class through your selection process. And for us, those are also very expensive because they tend to have multiple individuals involved in the litigation. And so the number one issue that we get is really on employment practices. And you think about it, if you're buying a rural bank and somebody's a CFO of a rural bank, and now they're no longer CFO of that rural bank, it's very, very difficult for them to find a similar position. So, and they've probably been in that, the CFO for 30 years. So they get pretty emotional when we deal with some of that litigation. The next is shareholder losses, and again, privately held companies are what we're focusing in on. It is difficult. It never fails, particularly in maybe multi-generational banks, that there is somebody who doesn't matter what the price that's paid or what the valuation is, they still think it's worth a lot more. And so we tend to deal with an awful lot of valuation disagreements, particularly on long-term shareholders. Sometimes they're just going to litigate out of spite. Sometimes they're just going to litigate out of pure emotion because they just don't want to have the bank sold. And so those can get expensive for us because we still are defending those even though there's no wrong that has been done. And then the next one is family disputes. These are the worst because sometimes there's absolutely no logic in it whatsoever. And it's sad to see it, but then the family starts to kind of tribalize, where you've got the acquisition side and you've got the no, grandpa started this bank side. And we get scenarios there where the litigation will go on for years. And I've got one in particular where the litigation went on, where the aunt had the stock, didn't want to sell it. She was, basically forced buyout, and she died. And we're now in the second generation of litigation, where her children are continuing the litigation, saying that we in fact think that we didn't want to sell this. Grandpa said never sell the bank, and that's where we're at. So,
Craig,
yes.
on those claims examples, those are also examples of claims that are arising under a tail policy.
Oh, absolutely.
Yeah.
Absolutely. That's I should say, yeah, that's where in the tail is where that really comes through. So, a couple of minutes, if anybody has any burning questions. We appreciate you taking some time out of your day to let's talk about insurance, but it really comes out to be pretty important, particularly when the disputes come up. So, any questions?
Nope.
All right. Well, thank you.
Thank you very much.